And welcome. This is Mary Ellen McGonagle with your Friday afternoon MEM Edge show. And this is the show where we bring you where the action is in the broader markets. Let's take a look at what we are going to be covering here today. As usual, we are going to take a look at the broader markets, a little bit of a bumpy ride this week. We'll see where we closed and what we can anticipate going forward based on that. Top headline news for the week. And this week, the markets were really very responsive to economic data that came out. We're going to get into all that. Also, pockets of strength in an otherwise dire market. I'm going to share with you some areas that are doing more than just holding up. They are actually have constructive charts. We'll review that as well as why. Also, building your watch list, and that continues to be a critical component, certainly for my work, with an eye toward when these markets do exhibit more broad-based constructive price action. You will want to be prepared. We'll share with you how that can be put together. And here we are with the headline news for this week. And so earlier in the week, we did get some relatively strong economic data points. The Purchasing Managers Index jumped in May. And then also earlier in the week, we did see the manufacturing index come in stronger and factory orders on the rise. And in a normally bullish phase in the markets, we like to see an expanding economy. Not so at this point. We are needing or wanting to see a little bit of softening, and it's all about the Federal Reserve's response to continued growth. In essence, the raising of interest rates, they may get more aggressive. So the impact with these numbers was that growth stocks did fall out of favor. Certainly earlier in the week, we did get on Thursday, ADP came out with their private sector job growth numbers, and there was a very significant drop. And hence on Thursday, we did see a big move back into some of these growth stocks and the broader markets. And we also did get today on Friday, US job growth came in stronger than expected, and the markets sold off really rather quite a bit. So I'll share with you, of course, that daily price chart of the markets, and you'll see that there was quite a bit in the way of volatility and just acute sensitivity to every data point. Next week, we're not going to get a whole lot of data until later in the week. We will get that very significant core CPI, that's consumer price index, very much indicative of where inflation is. Also, consumer sentiment and weekly jobless claims will be reported next week. So from here, let's go ahead, take a look at where we closed for the week. This is a daily price chart of the S&P 500. We did close the week down a little more than 1%, a holiday shortened week. So it's these four bars to the right that really define what occurred this week. And you can see Monday and Tuesday, we were down very much due to those stronger growth numbers. Yesterday's low private employment numbers drove the markets higher, and today we gave that back, certainly most of that. So we did end the week in negative territory. Let's take a look at these momentum indicators here. The RSI is waffling around this 50 level. So as long as we are above it, we're in okay standing. And then as we move here down lower, we can take a look at this faster moving stochastics momentum indicator above 50 is positive. So we do have that in place. Of note also is last week we did get what's called a follow-through day in the broader markets that took place on the 16th. And the characteristics that really had that move take place was a rally on the fourth day up from a bottoming attempt. And this follow-through day has significance because historically it has really highlighted and signaled the market bottom. It has called every market bottom going back historically over many market cycles. However, not every follow-through day does work. And we can need only go back to this March period. We did get a follow-through day right here that did stall going into April. So we're going to be, of course, keeping a close eye on that. There's a lot of other factors that need to be in place in order to signal a true market bottom, a true downtrend reversal. These are the kind of things that I get into with my MEM Edge report. Comes out twice a week and examines more closely than just the price action that's taking place in the S&P. It's a much broader view of what is really happening beneath the surface and how you can either capitalize on that or potentially not. So let's go ahead and move on. We want to take a look at those underlying 11 sectors in the S&P 500. I've gone ahead and populated this 2-month daily price chart candle glance view. Added that RSI, that's a relative strength indicator in descending order. So this is something that I do each week. I really am on the prowl for any kind of progression, either from this weaker lower quartile moving potentially up to the forefront, or industry groups up here or sectors that have been strong and are receding as it relates to that strength. So let's take a look. Energy, no big surprise up here in the forefront. This is XLE, that energy ETF. It's an area that we identified as my MEM Edge report as turning positive here on January 4th. And we do have several select stocks from that period that have been added. In fact, we have the top performing large cap oil producer that is really up triple digits, as well as other names. We've been continuing to broaden out that list. So let's take a look, move on, share with you some of these other areas that are up here in the forefront. Utilities, certainly more defensive, and also offering that higher dividend that is attractive during a high inflationary period. Materials here up in the forefront, and we can see that it's up above this key simple moving average here, above that 50-day. However, the basic materials group was down for the week just a bit, a little bit of mixed price action taking place among these areas. Gold was flat, but other areas came to life. And then as we move on, we want to, certainly from my work, I'm going to be really dialed into how this high growth technology sector is performing. And we can see, again, using these 4 daily price bars, how they responded to those higher growth numbers in the economy. And then Thursday's sharp rally on news that employment on the private side had gone down. But however, overall, we are still not in positive territory yet. We're on the lookout for certainly broadening out among the group and a break above that 50-day. So let's move on. We want to also be acutely aware of some of these areas that are really down and out. This is consumer discretionary, also viewed as a high growth area, higher multiple. And we can see the deterioration. This was all about weak earnings from Walmart, Target, and Amazon. And it did experience a bit of a bounce today. It outperformed in the sense that it was down only 0.5%. I would attribute a lot of that to heavyweight stock Amazon that was up over 6%. And that was all about anticipation of Amazon's stock split that drove that higher. There were other bright spots in discretionary as well. However, overall, the group is decidedly still languishing with its momentum indicators in negative territory. So you really would have to have conviction and pick your points if you are interested in participating in some of the stronger names in that group. So let's move forward, because this is another area, consumer staples, that really fell out of bed back here, again, in response to not only weak numbers from those heavyweight retailers I just mentioned, but more importantly, a weak outlook. And the sense that supply chain and inflation issues would continue to potentially keep consumer spending down. So the staples area did get hit in the sense that there was thinking that a number of these companies would also experience that same reduced spending pattern that has been taking place. what we're seeing here is somewhat of a V-shaped recovery attempt, but we are not out of the woods yet. Momentum is still in negative territory. We are seeing this waffling potential MACD crossover, but by and large, many of these staples names that got really hit quite hard are having a tough go as it relates to recovering. So let's go ahead back, because from here, we want to take a look even deeper in the broader markets beyond those sector ETFs. I've populated this 2-month candle glance view with a number of highly impactful groups, areas that are important, certainly not just in the current environment, but during normal periods as well, such as the yield on the 10-year. I want to see what biotechs, are they doing okay, the dollar volatility, and so on. Again, that relative strength indicator, descending order. No big surprise, Brent crude, and we do want to take a quick look here because it had a pretty significant gain in the sense that the per barrel price is now up there at 117, and that is an elevated level. It's going to continue to keep the growth prospects for those underlying energy names in place, and also the energy stocks. A lot of them have nice high yields that are another bonus. So let's move on. Another area that is important as it relates to last week's price action, the yield on that 10-year treasury is sneaking back up again, 2.95, and that 3% yield on the 10-year is a real noticeable, very much paid attention to metric. We are inching closer to that. Higher interest rates in the face of potentially higher economic growth. And of course, high interest rates are not good for growth stocks. So let's take a look at some other more impactful areas that were on the move this week. We can see semiconductors trying to reverse this downtrend. Thursday's big rally on the move into growth stocks, but we did close the week below that 50-day moving average, and overall the group did underperform for the week. Let's move on because we want to also take a look at the dollar. This is another highly impactful area, certainly as it relates to commodity stocks. We did see, as the dollar powered to new near-term highs back here in May, we can see that it is really just kind of bouncing around here, but the dollar is going to be certainly impactful again as it rises. Commodity prices tend to decline, and other areas as well. We do want to take a look at this volatility index. High volatility is indicating uncertainty and fear among investors. So it did dip this week. However, historically, it's still elevated. It's at about that 25 level. If we are in a more normalized upward trending market, the volatility index usually stands at around this 16 to 18 level. So up here at 24, we are still pretty high up there. So indicating that that fear and uncertainty is still out there in the broader markets. So we're going to take a brief break here. When we get back, I have lots more to cover. And we are back. First up here, I am going to share with you some stocks that are potentially making it onto my watch list. We're looking at Motorola Solutions. MSI is the ticker symbol. Very simple criteria here. I'm asking that the price of the stock be above that 50-day simple moving average. We have outside momentum indicators that are constructive as well. And for me, I do have a secondary criteria as well as those technical items. And that is that the stock has had an extensive rally. This is going into the peak in price for these growth stocks. I want to see that the stock does have that capability to power higher and faster than the broader markets, oftentimes due to high growth characteristics. So this particular stock does fit that characteristic. Also, it is offering a 1.6% yield. So in my work, I have noticed that the higher yielding is still quite a characteristic that is eminent and showing itself. So here we are with Domino's Pizza, DPZ. We are certainly early in this potential upside advance, but we can see that the RSI is up above that 50, trending higher. MACD had that nice early crossover signal, also in positive territory. Also has that characteristic going back historically, and oftentimes these big up bars on volume are related to strong earnings. However, it did have that higher multiple that had it falling out of favor with those higher growth stocks, a 1.2% yielder. So on the lookout for a potential continuation rally there. Another name that we can take a look at, and there were actually a couple of names in this area, not the prettiest of charts. This is RL, Ralph Lauren Polo. So upon closer inspection here, maybe not as exciting. However, it is trading at 12 times earnings, and it has a 2.8% yield. So I'm going to pull up a weekly chart here and give you a sense of that potential growth, but it's, again, not as lively looking or compelling upon closer inspection. Another name here in the exact same industry group is Levi Strauss, breaking back above its 50-day simple moving average, outside momentum indicators trending higher. So these are the kind of names that I will keep on my radar, keep an eye out and be on the lookout for future possible upside price action in addition to growth prospects. I'm sharing with you now another name up above that 50. We can see here it's had other downtrend reversal attempts. This is that other follow-through period. This is First Solar, FSLR, and it is a solar company. The estimates for next year are really high. For 23, they're anticipating 763% in the way of earnings growth. So keeping a close eye on this. Also seeing some what I can only call vibrancy in other renewable energy equipment type names. We are still super early in any potential upside, but keeping an eye on that one. I did want to point out that there is one area that's in technology. There are about 6 names in that sub-industry grouping that are really holding up quite well. So in technology, that's counterintuitive, giving the move away from growth. But this particular area has stocks that have a low multiple price to earnings. Often, a lot of them do have yields. They also have growth. So let's take a look. This is one name that I've been talking about for quite some time now. It's IBM. And we can see that it is powering to new highs, not at all what we are seeing elsewhere in technology. Some of the other characteristics here is the company offers a 4.7% yield. It's trading at 17 times trailing 4-quarter earnings. And they did come in with their earnings here, and they were very positive. The outlook was also constructive. So what I did want to point out, I'm sharing with you what is called a full quote view. So what you can do up here is very quickly assess that information that I'm sharing with you, that yield at a 4.6%. And actually the EPS on this for StockCharts is showing that's the earnings per share. The PE is showing at 23 times. I do use different charting services. The other one was a little bit lower, but certainly that high yield and high growth is being rewarded here. Let's just take a look at a couple of other names that caught my eye. They are in what's called the computer tech industry, and it's an industry by and large that provides consulting, engineering, and other services to businesses that are trying to really increase the productivity using technology. So that is not the name. DOX is what I wanted to use and share with you. This is Amdocs, and you can see that it's in a very confirmed uptrend, finding support at this upward trending 10-day simple moving average. Nice 1.8% yielder, trading at 7 times. Actually, the PE here is a little off 17 times is what I was showing. So this is certainly close to that, in essence, below the average for the S&P 500. The growth prospects for this company are quite strong. They came out with their earnings in early May. So this is this downtrend reversal, which took place in response. They posted 36% year-over-year growth, 23% above estimates that really thrust this stock into a nice uptrend. Analysts are revising the annual earnings estimates higher for this company. So let's see, I'll share with you one other name that caught my eye that has similar characteristics, also in that same computer services industry group. It's not going to offer a yield, but it does have that lower multiple. It has broken back above the 50-day. This is CACI. And then also other information that you can get from this full quote view is the market cap. So it's about a $6.7 billion company, mid-cap company, in the throes of potentially reversing this pretty severe downtrend. So I will move on from here because there's lots more that I want to share with you, and that is taking a closer look at some of these other higher dividend stocks that also offer a nice yield. So this is a theme that has been with us for some time, certainly this year very evident, and is anticipated to stay. It's not just high yield, low dividend. There is a need to see a growth factor as well. And in this case, we're looking at Pfizer in a more defensive area, healthcare. PFE is the ticker symbol. We can see that nice 3% yield trading at 12 times trailing four-quarter earnings. Let's take a look at the chart over here, and we can see that it is finding support above each of its simple moving average, your outside momentum indicators up here in positive territory. Now, we did get very close to a base breakout here at 56. The stock pulled back. So on the lookout for that potential breakout, which in turn we would like to see occur on heavy volume. Another area that is also on the rise, another stock, and I'll share two names in this grouping. This is Caterpillar, and many of you, I'm sure, are very familiar. It offers a 2% yield here, trading at about 18 times. It has been rather volatile. This volatility that we're seeing. There was certainly a period I shared with you. Let's just take a quick look here at the US dollar. So as the dollar rises, these larger multinational companies will tend to pull back. We did see, so let's go back to Caterpillar, take another close look. This is in tandem with that rise in the US dollar. And then more recently, we have seen the stock rally. We're back up above the 10, 21, and 50-day simple moving average, RSI in positive territory, as well as the MACD. So certainly it would take, for me, movement in other multinationals that are seeing growth, and we're not getting that. This is Deere, DE. These two stocks are viewed as really benchmark names within that certainly agricultural, mining, heavy equipment industry grouping. And when Deere is not participating in that. So let's take a look at another stock that has just broken back above that 50-day simple moving average. This is a mining stock, more in line with Caterpillar. And we can see RIO, it is a UK-based company, but it also offers a super high yield, 10.5%, trading at 5, almost 6%. I'm sorry, the multiple is at 6. With this price break back up above this 50-day, again, it has that ability to really have a super outperforming uptrend taking place back here before that US dollar rose. And more recently here, we have our outside momentum indicators in positive territory. A couple of other names here that we can take a look at that fit that general criteria: high yield, lower multiple, growth prospects. This is PKG. It is Packaging Corp of America, 2.5% yielder, 16% multiple. And we've seen this nice break back above that 50-day simple moving average. Your MACD black line up through the red, signaling that this downtrend has been reversed. Also that RSI up there in positive territory. And there's another one that is in that very same industry group. This is AMCR. And we can see this very pronounced uptrend that's taking place, all about earnings reported here. We can see that gap up on earnings. When you see a gap up into a base breakout, that is one of the stronger formations. We can see it really powered the stock so that it is in, again, that confirmed uptrend, 3.6% yielder at about 21 on that PE. So more than anything, using this particular name as a benchmark for PKG, which is also seeing growth. One other name that we can take a look at as it relates to higher dividend, you can see these charts are really not the most contained, a lot in the way of volatility. We're in this period where investors are really trying to sort out unprecedented. We haven't seen inflation this high in 40 years, interest rate policy, and quite a number of other factors that are taking place. But this is Huntington Ingalls HII, and it is a defense-related stock. I am going to share with you another defense stock that had a base breakout today. But for this stock, we can see it's breaking above each of these shorter term moving averages, your momentum up here in positive territory, 2% yielder, trading at 16 times. So one other area that I did want to talk about and share with you is there are actually stocks that are breaking out of basis. So let's take a look here. This is Northrop Grumman, defense name. It's up quite a bit. The company has been winning contracts of late, and it has a little bit of a yield, 1.4%, 13 multiple, but more as it relates to the chart. We can take a look at this nice base breakout, and it's occurring on pretty decent volume. We're going to see how it's closing. Actually, so here we are with today's move up 3% in an otherwise very difficult market environment. We did have that nice MACD black line up through the red crossover, and we can see that the stock, the company, I'm going to share with you a couple of other names that are in this defense-related space because it's beginning to show potential vibrancy, a lot in the way, certainly, of contracts with Russia's and Ukraine war taking place. There is a global increased spending. Now, Boeing, this is certainly not a pretty chart, but it did hit one of my screens as it relates to moving higher on big volume. We certainly have other names that I can share with you that are a little bit earlier in their potential reversals. These are all defense-related stocks. LHX, big move here. This is in response to Russia's invasion of Ukraine. And a lot of these names did give all of that and then some back. So on the lookout for a potential reversal and move back into stocks in this particular group. Let's take a look at another base breakout. And this is DAR, Darling Energies. It's in the agricultural, actual food products area, and they have seen growth taking place. We can see that the stock is potentially forming the right side of the base. And you can see we're not in a more normalized bull market because certainly this volatility by and large would be rather off-putting as it relates to putting money to work. So potentially this is more in line with sharing with you areas that are showing strength, again, in an otherwise rather difficult market environment. One last area that I can share with you that is seeing vibrancy within the group. This is a heavy construction name, Quanta Services, PWR is the ticker symbol. And it does, within that heavy construction, they do quite a bit of work with oil and gas pipelines, a very strong area, certainly of late. And we can see that it is in the throes of potentially forming the right side of this base. And I will leave it at that. For those of you that haven't already take a look at my MEM Edge report. You can trial it for 4 weeks at a very nominal fee. You'll be alerted to shifts in market sentiment. I've added several growth stocks you'll want to be aware of that are performing well. And that's it for this week. Look forward to seeing you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.